Since 1991, when the Soviet Union collapsed, when the world celebrated the triumph of capitalism over communism, the world stabilized and became ever more global, with the US becoming the only superpower that set the new world order. That drove prices down across the world, which kept inflation at around 1 to 3% for almost 3 decades. In fact, in 2009, as a result of the housing bubble, we had deflation. Price stability gave the businesses the confidence they need to invest in new technologies, build more effective supply chains, and expand their workforce. However, in 2020, the world was faced with a challenge that it wasn't ready for, including the US. That almost stopped the economic wheel, which led many countries to pump trillions of dollars into the economy to save it from the catastrophe that it could face. On top of that, the United States' global dominance was challenged by Russia, which created the highest inflation in 40 years. The Consumer Price Index rose 8.6% in May from a year ago, the highest increase since December 1981. Surging food, gas, and energy prices all contributed to the gain, with fuel oil up 106% over the past year. 8.6% might not seem a lot, but it's actually catastrophic. Imagine you have saved up $100,000 over the years. Even if you spend nothing out of that $100K, by the end of the year, they are going to worth $92.4 thousand. You might still see $100K when you check your bank account, but the real value is lower now. With $100,000, you might not be losing much, but imagine investors who are sitting on a pile of cash that's worth $100 million or a few billion dollars. Imagine for a moment how much money they are losing. Take Apple, for example, the largest company in the world. It holds more than $200 billion worth of cash. By the end of 2022, if inflation is going to be like 8% annually, then Apple is going to lose $16 billion just for holding that cash. $16 billion is more money than some countries' entire GDP. That's why the Fed's top priority now is to control inflation, because if investors are going to lose confidence in the dollar, that could end way worse than anything we have ever seen. Just take a look at countries where people lost confidence in the currency, like Venezuela. It's a nightmare that no one wants to witness. But controlling inflation isn't going to happen overnight. If it's going to happen by the end of the year, that will be great. But the main question is, if inflation is so high, why asset prices are falling? Why stocks plummeted so much when inflation is above 8%? And when they will finally recover? We'll answer all of these questions and many more. But before we do that, give this video a thumbs up and let's dive in. When you think of a business, the most important part is the cash, because generating a profit is any business' top priority. Of course, it has other responsibilities, such as delivering quality products or services and taking care of its employees. But if the business is not making money, no one wants to invest in it, which means eventually it will go bankrupt sooner or later. The company needs to put cash on the table to prove that its business model is working, even if that means waiting for 20 years like in the case of Amazon, or forever like in the case of Uber. At this point, it seems like Uber will never turn a profit. The sooner it puts cash on the table, the better, because $1 today is worth more than $1 tomorrow. If I would come out with two business ideas, the first one, let's say, will generate $5 million today, but the second will generate $10 million within 5 years from now. $10 million is obviously a lot more than 5. However, $1 today is worth more than $1 tomorrow. If you have those $10 million today, you can invest it and earn interest, for example, or reinvest it back in your company and maximize your profit. There are a gazillion number of things you can do with that $10 million if you have it now. So if we want to find the real value of that $10 million that the second business will generate, we have to find its net present value. how much that $10 million is worth today. There is a pretty simple formula for that called DCF, discounted cash flow. The formula is 1 divided by 1 plus the discounted rate to the power of the period, where n is the year. For the sake of simplification, let's say that the interest rate is 5%, which will be our discounted rate. For the sake of simplification again, let's divide the $10 million into 5 years equally. For the next 5 years, Company B will earn $2 million annually. If we apply our formula, $2 million that the company will earn 12 months from now is worth just $1.9 million. The next $2 million 2 years from now will worth $1.8 million. The third, $1.7, fourth, $1.64, and finally, the fifth year is going to be $1.56. All in millions, by the way. If we add them up, we will have a total value of approximately $8.6 million. So Company B might earn $10 million, but because it's 5 years from now, its real worth is just $8.6 million. So when the Fed raises rates, what happens to that discounted rate? It rises, which makes future cash flow less valuable than today, which pushes stock prices to plummet, especially tech stocks that often focus on making a lot of money in the future after gaining market share than now. Let's take the example of Tesla. Tesla is a great company. It builds great cars. It's revolutionizing the industry. It's led by a charismatic CEO. But the company is burning cash. It's a money-wasting machine. But investors are not worried because the promise behind Tesla is that once the company builds its infrastructure, it is going to make a lot of money in the future. Once it takes over the entire market, it will worth trillions of dollars. The key word is the future. But when the Fed raises the rates, the real value or the net present value of that a lot of money in the future drops, making the company less valuable and leading the price of the stock to drop. If you Google any stock, you will find out down below the chart company's PE ratio, which measures how much investors are willing to pay relative to how much its earnings per share. If the Fed raises the rates, future earnings suddenly become less valuable, which lowers its PE ratio and pushes the price of the stock to drop. However, not all stocks suffered when the Fed raised the rates, because the discounted cash flow rate doesn't just take into consideration the interest rate, but other factors that could influence the future cash flow, such as inflation rate, how easy it is for the company to get that cash, the opportunity cost, and so on. All these factors increase the discounted cash flow rate, which means the future cash flow will be less valuable. So if inflation rises, stocks plummet, except for those who are making money now, such as oil companies, especially when oil prices have risen so much lately. There is no one metric to analyze stocks. You have to look at other analysis, such as finding its price to earnings ratio, price free cash flow, or price to book ratio. None of these factors can tell you for sure how the stock will perform in the future, since there's so many factors that influences the price of the stock that the stock can fail even if everything looks perfect. But the main rule of investing is sooner or later the stock will rise or fall back to its true value. So the challenge is to find undervalued stocks, since in the long run they will rise back. That's it for today. Thanks for watching and see you in the next one.